Welcome to our eSignal weekly Forex forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. First market we'll cover would be the Australian US dollar. You see that the downslide here in the Aussie continues. No surprise for us. We have to peel out to a weekly to give you some perspective on this. We think that you're going to get into this zone really between, that's a pretty big one, really between 85 and 80 even. We think 80 even is a big level. We think you'll probably potentially even probe below there. But we think 80 even is where this market's going to go intermediate term, probably long term too. We're not as bearish on the Australian dollar overall as we are on the euro so much. So that's still a lot of, that being said, from here to 80 even, that's a lot of downside. That's over 700 pips. So we think that's our next stop in the Aussie, and we continue to maintain short positions and otherwise look to sell rallies in the Aussie. Next market, the dollar chief. We said last week that we thought the dollar chief would get to 95, and it did. It sure blasted through there. You're looking at probably almost exhaustive momentum at that point, but that doesn't mean that market can't continue to climb. So we're never going to pretend that we know what a market's going to do next. We're just going to go along with that market, right? So we've been bulled up for some time. We recognize that the momentum has been higher, and 95 even was a longer term target for us. So we got there. We wouldn't be too surprised if you did start to see a slowdown. But on the other hand, let's look at the big picture. This is why we continue to maintain long-term bullish positions in the U.S. dollar. There you go. There's still plenty of upside, right? I mean, the 2013 low hasn't even been tagged yet. That's all the way up at 98 and a half or so. And look at the 2012 high just below par. So longer term, yeah, this market is probably going to go to par. Shorter term, however, it looks like you're getting into exhaustive momentum on this market. But hey, long term, maintain those long term positions. Intermediate term, we're certainly looking to buy dips. We've been bulled up on this market for a long time. One of the reasons we love doing the weekly forecast like this is that there's a record of what we've said, so you can go back as long as you like it, as long as years, and you can see what we've been saying. And we've pretty much been a broken record about that, about the potential for a big rally in the US dollar. And you're looking at it here, and we cover this. We talked about the breakout right here and long-term breakout, and really that's where you're at right now. We peel out to a monthly chart, and you're really going to get scale here. There you go. So you can see that certainly 88 even is going to be in the cards, probably 90 even also, and that's not all that far away right now. So long term, that's where we're at, and that's where our focus is. Come back to the daily chart, which we see as a relatively short-term chart now, especially when you look at the scale of those higher time frames. And you do have to be mindful that you're seeing exhaustive momentum, but all the more reason to continue to focus on this market and look to buy dips in it. Here's the euro, and we're long-term. Just as we're long-term bulls on the U.S. dollar, we're long-term bears here. We think you've got quite a ways to go on the downside. Here's a weekly chart. Now, the euro, you can see it reached one of our shorter-term targets here, 127. We thought it was going to go there. When it broke down below 135 or so, we talked about that last week. That's a target, and just because you got there doesn't mean you just pull out of all your shorts, and because that's your downside target, you continue to monitor a market for its behavior. We're never going to argue with price, right? Price is king in this business, right? So you don't want to end up arguing with price, because you're going to end up on the wrong side, and that's not going to be pretty generally. We think long-term 120 is a reasonable target. But when you pan all the way out to a monthly chart, and even better, look at a futures chart, because that's going to give you more history for us. I love eSignal because I get all that long-term data, and that's so important. Most traders don't understand that. They don't look at enough history. Here's the funny thing. They don't look at enough history, and the other side of that, they don't trade short-term enough. You want to trade short-term because that's where your risk is the lowest. You want to manage those trades, at least a portion of those trades, on the long-term charts, because that's when your reward is the highest. But here this really sums up where we're at. We think 120 even is pretty doable. And then beyond that, we think that you're going to see 112. And if you see 112, the momentum will be such that you're probably going to see 110 potentially. So longer term, you're looking at 1,600 pips on the downside, right? So we're pretty bearish nonetheless, and equally so, we're excited to continue to sell rallies in this market. Here's gold. As bullish as we've been on the dollar, we've been, the opposite, beared up for gold. Here's what I want to show you in the gold market. 1,200 is a big level. I think that's where you're going. And the big question is, do you trade below 1,200? Well, this is gold. You can see how important 1,200 has been to this market. I'm going to show you silver. Silver is a leading indicator market for gold historically. Silver tends to lead gold. You want to know that. Look at silver did. Silver's already below the 2013 low. Silver made a lower low here, so that's pretty bearish for the precious metals complex, i.e. it's bearish for gold. So if you had to ask me if gold's going to trade below 1,200, here it is again. I'd say yes, it likely is going to, particularly with the downside momentum you have here. So we think further lower gold prices. Dollar yen, keep it short and sweet. We're looking for 110. We thought 108 was our target. We said, well, with the momentum, you're gonna go beyond that. You're probably gonna see 110. Haven't quite got to 110 yet. It's just below it. So we think 110 is still in the cards here. Short term, you're gonna continue to buy dips in the dollar yen. Hey, thank you so much. I'll leave you with these words of wisdom from my good friend Bill Williams. Holding on to an outcome creates an energy blockage. That is so true. You have to be very, very careful what you expect to happen, because it's going to create an energy blockage. It's going to blind you to see what is happening. You really have to accept the world as it turns. You really have to accept things as they come your way as a trader. So you have to be very careful when you want to hold on to an outcome. And of course, you have to trust your method and just let go. And trusting the method for us comes with seeing the stats, the statistics that our market generates over months, over years. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you next time.